Welcome back, everybody, to Magnolia on Money, where we discuss everything financial from the economy to retirement. I'm Ed Cox with Magnolia Wealth, and today I'm going to do a quick wrap-up of what's going on in the economy, some of the risk that we see out there, and just overall a couple of high points with inflation. And I think it'll help maybe frame where we are and what happened at the beginning of the year, and then maybe kind of what we're seeing happen in April as we've lost a lot of the ground we gained in the first quarter of the year. So I've got, as always, got a slideshow to share with you. So growth, the end of last year, so the fourth quarter of 2023, we saw the economy really expand at a pretty good rate of 3.4% on an annualized rate. So that's, even though it was a pullback or deceleration from a strong third quarter, it was well above, expected growth of the U.S. economy. So we pulled that all the way through into the first quarter of 2024, and we saw the market really, really improve. The market did really well in the first quarter, and that was really where a lot of that good news pushing the market up, where that came from, was we had really good growth, and it was definitely above expectations. So that was really good. So the things we need to be looking out for, the stalling progress on getting the inflation in check, definitely is delaying rate cuts. It is a risk, but I think the longer we can go without taking rate cuts and the Fed can continue to pull money out of money supply is a good thing. But it does present some challenges on the stocks and bond side. Typically on the bonds, we really expected rate cuts to come maybe a little bit faster than they seem to be, which will push the bond returns we were expecting, mid-year, maybe towards the end of this year and maybe even first of next. So, at some point it will come, but that's some of the challenges that we see in the stocks and bonds. The other risk is any slower moving economy, which the economy is slowing down, even though we're above expectations of where we thought we would be. A slower economy is more vulnerable to any kind of change or shock to the economy. So those are risks that are out there, and we're have to pay attention to that. And the last one is elevated valuations in some parts of the market may lead to a more volatile market and market correction. So there's parts of the market that are the valuations are very, very high on those companies, and so we just need to be aware of that. And as we adjust portfolios here, to maybe take some of the gains we've gotten off the table and move to some of the assets that may not be as overvalued. But that's something we work on in the office. But these are the risks we face. It doesn't mean that this is going to come to fruition, but it is some of the things that we are looking at. And then last, you probably know this, but the March Consumer Price Index report came in stronger than expected, which is what has pushed the Fed's decision to possibly decrease rates on further down the road. Some of the same drivers to this: energy prices rose. We've seen higher gas prices, and then we did see food that kind of remained steady, but we did see March CPI numbers stronger than was expected. Well, I hope that's helped. That gives us a little, snippet as to maybe what's happening in the economy and what kind of risk that are out there and what we look for as we move forward. It's going to be a very interesting year. We'll have a lot of things to talk about on the show this year. I'm pretty confident in that. So y'all stay tuned. As always, God bless. We'll talk to you next week. Take care.